I'm 61 years old. I'm healthy and I feel great, but nobody knows what tomorrow brings. And that is why life insurance matters. For me, this isn't just theory. My balance sheet's solid, so you'd think my daughter would be just fine. I own businesses, real estate, but most of those assets are not liquid. Because I invest pretty often, the assets that I have are not the same as cash sitting in my checking account. If something were to happen to me, she would need cash to pay taxes, legal administration, and deal with her own immediate cash needs. I would never want her to be forced to sell solid investments at the wrong time just because she needed cash. Life insurance can help provide financial security, breathing room, and options for the people that you love. I have done it differently. I've had the nurse come to my house, draw blood, weigh me on the spot, and it was weird and uncomfortable. But Ethos is a platform that helps you find life insurance fast and easy, and it's 100% online. You can get a quote in seconds, apply in minutes, and coverage can start the same day. There's no medical exam. You just answer a few health questions online. You can get up to $3 million in coverage, and some policies are as low as $30 per month. Take 10 minutes online with Ethos today to begin the process to get covered with life insurance through Ethos. Get your free quote at ethos.com/Paul Morris. That's ethos.com/Paul Morris. Application times may vary, rates may vary.
This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
The Federal Reserve didn't blink. Should you? The Federal Reserve met this past Wednesday and there was no cut. In fact, 3 officials voted to raise rates, and mortgage rates hit a one-year high anyway, and that was 6.66% according to Freddie Mac. If your 2026 plan starts with when the rates come down, this episode is your intervention. Welcome to the State of the Market. I am Paul Mark Morris. This is the Paul Mark Morris podcast. I am a brokerage owner, investor, and attorney. Today, the 3 numbers that matter, what the Fed actually said, my view on where an investor finds certainty when the Fed provides none, and 3 decisions for your next 90 days. One quick note before we start. I'm an investor and an attorney, but I'm not acting as your investment advisor or attorney here. This podcast is my personal market analysis, not legal, tax, financial, or investment advice. The full disclaimer will be at the end of the podcast, so let's get into it. Segment 1, the numbers you can't afford to miss in under 2 minutes. The first number is 6.66%. That is the 30-year fixed rate, according to Freddie Mac. And this is the 4th weekly increase in a row and the highest it's been in a year. The second number is 923, and that was the Fed's vote on Wednesday to hold the rate where it is. And the 3 who actually broke ranks voted to raise the rates, not cut them. The third number is $440,600, and that is the median price of a home sold in June, according to the National Association of Realtors, and that is an all-time record, while pending sales fell 5.4%. And when I say pending sale, I'm talking about the houses that are under contract, so contract fully executed but haven't closed yet. So the number of houses under contract that went under contract fell 5.4%. So we've got a high number in terms of the sale price and less homes going under contract at the same time. Those 3 numbers tell the whole story. Money got more expensive, prices are holding, and buyers are hesitating. That is the standoff that I talked about in last week's State of the Market, and everything else today for the State of the Market hangs on those 3 numbers. So here's what we were waiting for. The Federal Reserve Board met, and here's what they said. They held their interest rate at 3.5 to 3.75%, and the vote was 9-3. The nine voting to hold the rate, and 3 dissenters were actually all wanting a quarter-point hike. A year ago, the whole debate was whether the cuts were coming. Now the argument inside the building is whether to raise rates. Chairman Kevin Warsh said 3 things that are worth talking about, and he called this, quote, watchful thinking, not watchful waiting. He said that 5+ years of high inflation, and this was his quote, cannot be cured in 9 weeks. And he said the Fed will not hesitate to act. Will the Fed raise rates in September? The honest answer is they won't say, and this Fed has stopped making promises about its next move. But the market votes every single day, and the futures market currently puts it at roughly a 7 in 10 odds on a quarter-point hike by September. Not a cut, a hike. And my read is simple on this. The rescue is not coming. Plan on today's numbers. If something better ends up showing up, that is a bonus. The next Federal Reserve decision comes September 16th. The next inflation report comes August 12th. Those are 2 dates you should put in your calendar because they will decide the market you're operating in this fall. Segment 2, the ongoing war, oil prices, and your mortgage rate. 1 minute on the war again because it absolutely impacts your interest rate. After a week of missile strikes and a Saudi-led push to protect shipping, Brent crude, remember that's the international index, is around $88, somewhere between $88 and $90 per barrel. That's up more than 20% for July. And here's the simple thread to follow. This is how the war ties to the interest rates.
This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
War keeps the price of oil volatile. Volatile oil prices feed the risk of higher inflation, and inflation risk pushes the rate of the bonds higher. Higher bond rates equal higher mortgage rates. So that's how the war ties directly to your interest rates. And the bottom line is, until the Strait of Hormuz is genuinely settled, that risk premium, the premium of this uncertainty, will live inside every rate you're quoted. That's the whole story. So let's move on. Segment 3, I want to give you my view, and that is when the Fed creates uncertainty, you can create certainty by negotiating a better deal. Stop trying to predict what the Fed is going to do. You can't control interest rates, but you can control the deal you're making. You can negotiate seller financing, perhaps. Definitely look into it. You can get a rate buy down. Again, these are possibilities. These are things you can ask for. And always check to see if you can assume the seller's loan. In most cases, I find that you cannot do that, but it's definitely worth looking at for sure. And some people actually will go out and hunt for deals that have an assumable rate because you might be able to get a rate much lower than the current rates now, and that adds a tremendous amount of value. Additionally, you can negotiate more time for the closing if that's something that's going to help you. And a lot of times in an investment deal, that will help you. If you're planning on making renovations or changes to the building or structure, you can build those into a longer timeline, and you can do that before the property closes. These things definitely matter, and they change how good or bad a deal is. Right now, sellers are more often willing to negotiate terms than they are to cut price. That's my experience, and I think the market is showing that. And the investors who win aren't necessarily the ones that are getting the best price, but the ones that are getting the best deal in a negotiation. They are also certainly not the ones that are predicting the future. They are the ones that are able to negotiate right here, right now, when the market has stalled a bit. Segment 4, let's talk about what some of the quote experts are saying. And again, I refer to this one because it really went viral, and that is Robert Kiyosaki. I've met him in person. Super interesting guy. He's the author of Rich Dad, Poor Dad. And this last week, he again said the global economy, this is a quote, is crashing and the US is bankrupt. Millions of people saw that. I watched them, I watched their reactions to it. And so I want to do a reality check against that quote. And I'm going to do that with this week's numbers. The economy actually grew 1.5% last quarter. Consumer spending sped up. And right now, this is an absolute key point. Fewer than 2% of homeowners owe more than the house is worth, something we call, being underwater when you owe more than the house is worth. But according to CoreLogic, less than 2% of homes in the United States are underwater. And contrast that with a financial crisis when the bottom really fell out of this market in 2009, and that was a massive 26%. That's a huge difference, and it is the difference between a market under pressure, which I think is our market right now, and a market in collapse. Do these numbers mean that we're out of the woods? Definitely not. We have serious issues. The federal government has huge debt. That's what Kiyosaki is referring to with, the government is bankrupt. So there's some facts behind that. Inflation is still running well above the Fed's target, nearly double. I think the last number I saw was 3.7%, and the Fed targets 2%. So a fair amount higher inflation rate than the Fed would like to see, and that is normal. So these risks are real, and they deserve to be taken seriously, but they are not, in my opinion, pointing to a real estate or total market crash. I rely on the data, not the headlines, and if you do that too, you will distinguish yourself. Segment 5, your next 90 days. 3 decisions to really look at with your own experts and your own market. Decision 1 is rerun every number at a bare minimum with the current interest rate, and that is 6.66%. And I prefer to stress test deals a little higher. So do your current deals, the ones that you currently own or ones that you're looking at buying, do they work at 7%? That gives you a really little piece of cushion to help you out. If they can stress test a little higher than the current rates, then you can enter a deal with some safety. If these deals don't work at today's rate, don't talk yourself into it. Decision 2, know the loan documents before you start arguing about the price. I know there's a mountain of fine print, but there are 3 things you should know cold on any deal you own right now or any deal you're looking at. Number 1, is the loan assumable? Some mortgages let a buyer step into the seller's existing loan and keep the seller's old rate. A seller sitting at 3 or 3.5% is holding something a buyer wants more than a discount. Most conventional loans don't allow for it, which I rarely see it on normal loans and normal deals, but government loans often do. And it's important enough, it changes the deal so much that you should definitely ask for it every time and possibly even look for it in new deals. Another point, absolutely key, and that is if you've got an adjustable rate, how high can it go? There's usually a ceiling written into the loan, and you've got to find that number because that number is your worst case scenario, and it's what the deal has to be able to survive. Not today's rate, but the ceiling of that floating loan. And so this is the mistake that many people made when they underwrote deals and then they bought them at a 3% rate or a 3.5% rate that was adjustable. And now they are literally looking down the barrel of a shotgun when rates reset. Many deals cannot survive this reset. So buy now only if the deal can survive the upper limit of a floating rate, or buy into something that doesn't float for a long time. Adjustable rates are sometimes 5 years, 7 years, sometimes they're 15, and I certainly have bought deals with a 30-year fixed. So that takes that off the table and creates certainty. The upper limit of an adjustable rate is something you've got to consider before you get into a deal. The third thing is what happens when the loan comes due. Short-term loans have a finish line, and most of them have an option to push the total payback date out. But you've got to understand, is it an option that the borrower has, or is it something that requires the lender's approval? Because if it's an option that's baked in that the buyer has, you have real choice. If the lender has the choice, then you're really asking for a favor when the loan comes due. That's not a position you want to be in. Decision 3, get your calendars out. Circle August 12th. That is when the inflation report comes out, very significant and important. And also September 16th. That is the next time the Fed meets and decides whether they're going to adjust rates or not. You need to know these two numbers to know the playing field that you're playing on, and those two dates are really going to help you as we move into the fall. Here's a quick disclaimer. Nothing in this episode is financial, legal, tax, or investment advice. I'm sharing my personal opinions and analysis as of today. They are not recommendations to be relied upon. Markets change, and as I always say, markets are local. Every deal is different. Before you make any investment, consult your own professionals, your CPA, your attorney, your financial advisor, a great realtor, and do your own due diligence. That's the state of the market. Subscribe, send me your market and your questions. The best ones get answered on air. I am Paul Mark Morris, and I'll see you next week.
The right window treatments change everything. Your sleep, your privacy, the way every room looks and feels. At Blinds.com, we've spent 30 years making it surprisingly simple to get exactly what your home needs. We've covered over 25 million windows and have 50,000 five-star reviews to prove we deliver. Whether you DIY it or want a pro to handle everything from measure to install, we have you covered. Real design professionals, free samples, zero pressure. Right now, get up to 50% off with minimum purchase, plus get a free professional measure at Blinds.com. Rules and restrictions apply.
I'll be honest, shopping for clothes is not my favorite thing. I just want to look good without overthinking it. Stitch Fix makes it easy. You take a quick style quiz, your size, your vibe, your budget, and a real human stylist sends a box with clothes that actually fit your life. Try it on at home, keep what works, send back the rest. Shipping's free, no subscription required. Get $20 off at stitchfix.com/Spotify. That's stitchfix.com/Spotify.